if you're not in it, you won't win it. And that is not true of the small tokens because we don't know what's got network effects, i.e. what's going to last. Are people going to build on it? That becomes speculation. That's okay, but you need to understand what you're speculating in. But if you're putting your bulk of your savings in, go for stuff that's proven. So right now, Bitcoin and Ethereum are the most proven. Like Solana has mass adoption, but it has issues like the chain break. So you wouldn't want to put all your money in Solana, but if Solana wins the game of mass adoption, okay, they're going to do really well. If Avalanche solves it for speed, they will do really well, but they're yet to be proven by gigantic networks.
Hello and welcome to Money Talks. In today's video, Real Vision CEO Raoul Pal shares his macro thesis about investing in cryptocurrencies like Bitcoin, Ethereum, Solana, and Avalanche. He talks about the key lessons he learned from buying Bitcoin along with his opinion on Ethereum, staking your crypto, and so much more. Make sure to stick around till the end of this video where Raoul Pal reveals why he firmly believes that we're in a recession right now.
You remember we've just talked about risk, where the low end of the risk was owning bonds and the high end was buying crypto and technology stocks. The same applies in all assets and all asset classes. So taking crypto as an asset class, so the least risky, the least volatile, the safest is Bitcoin. Still goes up and down 60 or 70, 75%, I think, peak to trough. So you need to be aware of the volatility, which is why leverage is not very useful in this space. It always seems attractive when prices are going up, but you get utterly destroyed when they go down. It's too volatile to use leverage. And I always say you don't need it. If we're talking about 10x, 20x returns out of Bitcoin itself or Ethereum or some of these big ones, why do you need leverage? Really? You're trying to make 100x on your life savings? Are you mad? I mean, you don't need to do that. These are big opportunities. So then when you're looking at the risk, what happens is people get They suffer two things. One is the illusion that, Ethereum's at $2,000, whatever the number is, or Bitcoin's at 20,000, 30,000. I can't afford one, right? Which is a complete misunderstanding. They all fractionalize down to like 8 decimal places. What that means is you, me, the 23-year-old who's got, $50 a month to put in the crypto market can all put the same percentage of our disposable income in and all benefit to the same percentage, which you can't do in other things, right? There's a lot of things in most financial markets that you don't have that equal playing field. So everybody can participate. So that's great. But everybody has this illusion about price. It's like, well, I can't afford a Bitcoin. You don't need a Bitcoin. You just buy whatever you want to do. Secondly, there is this illusion that everybody else is making money in these small tokens, and you see it, and it seems fun and exciting and gambling, and you kind of want to do it, and it gets your blood. Oh, I need to do this. I need to do this. Everyone's making money in the metaverse, and I'm not. They're making money in this NFT, and I'm not. And it's FOMO. Now, it's actually fun in the space, the FOMO and the ridiculousness. And people joke, laugh with each other. I mean, we've got here at Real Vision, one of our Slack channels internally is like filthy degens because people are degenerative and they kind of embrace it.
Bitcoin could be poised for outsized gains if recent technical signals are to be believed. Investors have been searching for a bottom to Bitcoin since the cryptocurrency lost more than 60% of its value from the all-time high of nearly $69,000 it hit in November. Nearly $2 trillion has been wiped off the entire crypto market in recent months.
These small tokens, knock your socks off, but do it with 10 or 20% of your savings, of your capital. The rest you allocate into the safer assets, whether it's Bitcoin, Ethereum, Solana, Avalanche, some of those big layer ones where you've got a higher probability of success. And again, the risk curve is Bitcoin is the least risky, Ethereum the next, then there's a whole bunch after that, the kind of Polkadot, Solanas, AVAX. And it doesn't mean they don't come without risk. We learned that from Luna. Things have risk. This whole space has risk, but the least risky Bitcoin needs. So I would construct a portfolio if you do enjoy the degen activity and you want to enjoy that. I'm going to get rich on this thing, right? It's a human trait. Embrace it. The space embraces it. You ape into tokens, you have fun, you get wrecked. It's all part of it. And it also teaches you lessons. I'm stupid. I was following somebody. I didn't do the research. You learn a lot of good lessons from doing that stuff. And it's a bit boring to buy and hold. I mean, 90% of everything I do is just buy and hold. And I don't do anything with it. And it's you always get a bit of FOMO. So I always have a bit of money for FOMO so I can just mess around and get involved in the community and the fun of it and the movement of it, because that's fun too. So that's how I'd approach it. Don't use leverage, because the whole game is to stay in the game. That is the entire game here.
A measure of activity of Bitcoin miners could give investors a clue as to where the digital currency is headed next. Miners validate transactions on the Bitcoin network using highly specialized and power-intensive computers to solve complex mathematical puzzles. They are rewarded in Bitcoin for their efforts. As more Bitcoin is mined, solving these puzzles becomes more difficult. During market slumps, a depressed Bitcoin price can make it unprofitable for many miners to continue operations. They then sell some Bitcoin to keep afloat, but they also turn off their mining rigs to save money.
Now, we are more correlated to the Western economies that are slowing down fast. So we are seeing, I think we are in a recession, and I think it's actually going to be pretty nasty. The nexus of a strong dollar, the high interest rates, high inflation, means that people don't have as much money to spend, and they're scared. You see the sentiment surveys and people are scared. So you may not see it from your audience in the Middle East, but you'll see it in the US or the UK. I mean, the UK just announced today that they expect, 5 quarters of recession, and they're still raising rates, and they've got massive inflation. So it's a really ugly situation here in the kind of Western hemisphere right now, and that's not going away for a while. And the other engine of growth, China, is not an engine of growth right now either. So that makes it more difficult to navigate, but you guys are slightly more isolated than we will be here.
Okay.
That has happened in the latest market slump and can be demonstrated by hash rate, a measure of computational power used to mine Bitcoin. Since mid-May, when the market really started to sell off, the 30-day average hash rate, a monthly average value, fell more than 7% and at one point saw a 10% dip. That signaled that miners were turning off their machines. Hash rate, studied in various ways, is used by crypto investors to try to figure out when the market might bottom, because capitulation and a shakeout of miners is often associated with the late stage of the Bitcoin cycle.
Yeah, and you will see some of that in Dubai because rates go up and everything else. So you will see some of that, and you've got the inflation issue, but you have these secular things that balance it out. The US, for example, massively overbuilt property in too short a period of time, because they extrapolated the trend rate of growth after lockdown when everybody bought a new house and wanted to move out of cities. They assumed that was normal, but don't forget rates were almost zero. We then had a rise of rates that mortgages are now higher than they were in 1996. So suddenly everyone's like, oh shit, I can't pay my mortgage. But the price of their shopping in the supermarket has gone up huge too. And so suddenly it's like, oh, I've got no income left out of my paycheck. What do? Do I get rid of my property? Well, property prices are starting to fall. Or do I stop any other consumption? And we're seeing that all over the place, where people are like, I can't afford to do that. It's one of the things that actually hit the crypto market, because many people were dollar cost averaging with a bit of excess cash. They put it in, like good investors. Problem is, suddenly they've got no excess cash, and you kind of took a whole bunch of buyers out of the market. But let's assume they're relatively young and want to make capital gains. If they're relatively young, want to make capital gains, then the two areas that will be massively discounted are both crypto and the kind of very growth end of technology. And why those areas are, they're both in secular uptrends, right? Technology is not going away. The EV revolution is not going away. The autonomous driving is not going away. Space exploration is not going away. AI is not going away. They're accelerating, right? So if you've got this trend of adoption and rising prices over time in the share prices, and you're right at the bottom of that trend, you kind of know that this adoption is going to continue. There's no way that technology doesn't continue. So therefore, it gets incredibly cheap every day. It doesn't go up over time. And a lot of this stuff is down 80%. Things like Shopify or whatever it may be. So that gets really interesting. And crypto's the same. It's even got a faster, steeper curve over time. More and more people are flocking to it. And the prices are down 80%. Well, between 50 and 80%. So these are the times where, let's say there's another potential 50% downside, let's say, because crypto is very volatile. What is the upside? Usually when you get to this kind of oversold levels, so I use stuff like the 5-year moving average, you find that the upside is 10 to 20x. So you've got a 0.5 downside, 10x upside, right? These kind of things don't happen many times in your life. So if you do have a bit of cash, buy what everybody's sold, not what everybody's buying now. And everybody's buying now. If we're talking about Dubai, people are buying property. Okay, that's been a good trade, but is it likely to generate 10x? No chance, never. Well, not in 5 years, not in 10 years, maybe in 20 years. So, or longer. So those are the opportunities I'm really looking at. Yes, you always need to distance yourself from your P&L. And ask yourself, okay, what am I doing right? What am I doing wrong? What I really strongly urge people to do is write down the thesis for the trade or the investment they're making. If you say, well, I'm buying this NFT because I think it's going to go up 50% in price over the next 6 weeks because it's a hot project, fine, write that down. And if it doesn't meet your criteria or it does the opposite, you close it. With the long-term investing, you need to say, my time horizon is, I want to be in this trade for 5 years, 10 years. My objective is to add when it sells off more than 20%. Every time it falls more than 20%, I'm going to add some. And whatever it is, and I'm really wrong if this happens. Write it down and then refer to that every time you think you're about to trade and do something. Because you forget, which I forgot. I forgot that the long-term objective was, because the money was worth more. So I'm like, well, I should save that money. I could take that money off the table. But I actually destroyed my future returns by doing that.
So what is your perspective about Ethereum, Solana, and Avalanche? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.